If you follow along with the news, you might be familiar with the fact that the Tax Cuts and Jobs Act, otherwise known as the Trump tax cuts, are expiring at the end of 2025. There's going to be a lot of questions of what will happen starting in 2026 and moving forward. But I think what we want to talk through today is what this means specifically for retirees. If you're planning to retire soon, or if you're in retirement, changes to this landscape can have a pretty drastic effect on the amount that you pay on several different areas of your actual tax plan. I think it's important to make sure that you understand the changes that took place in 2017 and moving forward, and the changes that could take place in 2026 moving forward. So that's the plan for today's video. If we haven't met yet, my name's Danny Sinowitz. I'm a CFP professional from Hyperion Financial. And the video that we're watching today, again, is going to be geared towards retirees and the plans that could be made in the event that the Tax Cuts and Jobs Act is extended. And what are some of the provisions that are being talked about? And how can you best position yourself to where you're paying as minimal amount as possible when it comes to the tax that you're going to owe? I think it's good to first start. What did the actual Tax Cuts and Jobs Act do for retirees? So, the Tax Cuts and Jobs Act that was passed at the end of 2017 had a number of different wide ranging effects across tax policy for numerous individuals as well as corporations. But if we're focusing specifically on retirees, I think there's a couple areas in which it really had a drastic effect. One of the areas that I think really helped was the decreased tax brackets that individuals would pay on their ordinary income rates. So what you're seeing here is what the ordinary income rates looked like in 2016 and 2017 versus 2018 and moving forward through 2025. Now, understand that the amounts that were actually paid have been indexed for inflation. But when it comes to the actual percentages, those have remained level. So as you can see, the percentage rate in which you'd be paying tax is actually significantly lower starting in 2018 and moving forward. One other thing that became helpful for retirees is the increase in the standard deduction. The standard deduction nearly doubled from 2017 to 2018 due to the Tax Cuts and Jobs Act. And if you're unfamiliar with what the standard deduction is, it's an amount that you can actually deduct from your ordinary income, thus resulting in a lower income tax rate paid. And yes, there is always a trade-off, just like we talked about. So one of the things that was actually taken away were personal exemptions. And personal exemptions were an amount that you could actually deduct from your taxes based on individuals. So for retirees, a married couple would be able to utilize a personal exemption of $4,050. For a married couple, that would be $4,050 each, totaling in $8,100. However, the increase in the standard deduction likely would have covered the difference in eliminating the personal exemption for most individuals. But it also would have either removed or eliminated many of the itemized deductions that retirees may have utilized in the past. One of the changes that did take place is the interest deduction that you were able to utilize on your mortgage. And what you would have been able to utilize is up to $1 million is what would have been able to be deducted from the mortgage interest. But starting in 2018 and moving forward, that number was decreased to $750,000 of mortgage interest. Previously, you would have been able to deduct home equity loan interest as well, but many of the provisions of that were taken away, where only certain individuals, depending on the usage of that home equity loan, would have been able to deduct that interest moving forward. One of the big ones that actually was decreased was the SALT deduction, otherwise known as the state and local tax deduction. Previously, for retirees who live in high tax states or that have high local tax that they would be paying, the decrease to $10,000 on the SALT deduction can actually be a pretty substantial difference if they're living in a high tax state otherwise. Another big thing that took place was the ruling on Roth conversions. And if you're not familiar with Roth conversions, I'm linking to a video right now, which I think may help explain and give you a better feel of what they are. But prior to the Tax Cuts and Jobs Act, you were able to recharacterize a Roth conversion. And what that means is if you did a Roth conversion going from traditional to Roth, if you thought that you made a mistake or wanted to then go back to traditional for some reason, you wouldn't be able to do that any longer. Going from traditional to Roth became a move that was permanent. As a result, the Tax Cuts and Jobs Act really made Roth conversion planning something that you want to make sure is right for you. And again, if you're not sure if it's right for you, checking out the video that I'm linking to should be able to help with that. And while you're at it, if you haven't yet, be sure to subscribe because we focus quite a bit on tax planning on this channel. So if you're interested in understanding how taxes work in retirement, This is the channel for you. Make sure you subscribe so you never miss an update. The last thing that we should be keeping in mind is the federal estate tax exemption as well. So prior to the 2017 Tax Cuts and Jobs Act, the estate tax exclusion was $5 million per person. It doubled in 2017, and it has since been adjusted for inflation. It's now grown to just under 14 million. However, if the Tax Cuts and Jobs Act were to sunset and expire without any action being taken, this then would default back to right around 7 million. The Tax Cuts and Jobs Act is actually set to expire at the end of 2025. There's been a lot going on in the news, so I can understand why this maybe isn't the top dominant story. But if it does sunset and expire, we'll revert back to the old tax rule. This could lead to a pretty significant change for retirees and could have a pretty large impact on your retirement when it comes to your finances if this does take place. Now, I don't know what's going to happen. We're filming this video in spring of 2025, and there's a long way to go until December and moving forward. So we could notice that there could be some changes between now and then. But in the event that it does expire and we revert back to a previous tax law, I think there's going to be a pretty drastic effect for retirees across the board. Now, what would this look like if the Tax Cuts and Jobs Act is extended? I do think it's a real possibility, being that Republicans have a slim majority in the House, they control the Senate, and then they also have the presidency. However, it's not quite as simple as thinking that this will just pass and extend with no changes. There are going to be some things that Congress needs to look into, including how they actually plan to pay for the extension of tax cuts. And with such a slim majority in the House, there may need to be some concessions that are made by Republicans and Democrats alike to make sure that this bill passes. Now, when it comes to actually extending these tax cuts, again, being that Republicans control Congress and the presidency, it's likely that they're going to use some level of what's known as the budget reconciliation process. And this can be more of a procedural term and a political term, but it does decrease the amount of votes needed in the Senate from 60 to 51. If this does happen, what we're going to have to see is that they're able to pay for some of the offsets in revenue that they'd be able to cover otherwise. So again, there's going to need to be some finagling of the numbers to really make this work. So the question becomes for retirees, well, what is it that you should be doing? I think it's good to make sure that you have a plan of what's going on in your house before we understand what's happening in the White House. We cannot control what's happening in the White House or in Congress, but we do have control of what's happening in our house and making sure that our financial plan is in order and making sure that we have a plan to address taxes regardless of what happens. I think the first thing you want to do is continue to stay informed and making sure that there are going to be changes that are taking place, and the moves that are taking place that are going to have a direct impact on your future are done with the sense of an intentionality. But what I also think you can make sure of is that as you're following along, you're making sure that you're taking advantage of some things like the lower tax brackets that we could be in for this year. Regardless, it's making sure that you have a plan in place to pay tax now and pay tax in the future at the lowest known rate possible. Lastly, one other thing that has been discussed and could be a part of the Tax Cuts and Jobs Act is the taxation of Social Security benefits for seniors. It's been a hot topic, and on the campaign trail, President Trump hammered this point home quite a bit. If you have questions on it, or if you've not yet checked out the video, be sure to check out this video right here, which is going to cover how the Social Security tax has worked in the past and what it could look like in the future.